Is your homeowner's insurance cost climbing every year, affecting your monthly budget?
I can't stand it anymore.
I know, probably doesn't make you feel better, but you're not alone. Watch on so I can offer you a few practical solutions on lowering your insurance costs and saving you a little bit of money. Hi there, I am Gurfinkel, a senior loan officer with almost 30 years of experience and over 2,000 families served over my lifetime. I am here to break down the complexities of mortgage world in simple terms and offer you blunt and practical advice to help you avoid the common pitfalls. Now, don't like or subscribe if you don't find this video helpful, but to find that out, you'll have to watch until the very end. So let's look at the origin story. Why are the home insurance costs rising and keep on rising, and how do we get here? First of all, you probably guessed it. Yes, inflation is the culprit. Because let's face it, inflation drove the cost of supplies up, building materials, what have you, and inflation drove the cost of labor up. Now that's two things that the inflation has affected. And as a result, now costs more to repair the damage to the home, God forbid anything should happen to it, which is what the insurance is for, or fully rebuild your home should the home get destroyed, whether it's a fire, flood, or another natural disaster. So guess what? The cost to rebuild skyrocketed, therefore the cost to insure also followed the same sky-high trajectory because the insurance covers and is there in case you need to rebuild your home. So yes, inflation is to blame. But then on top of the inflation, there are other individual factors that majorly affect your cost of insurance, and we're gonna focus on what you can do to change those. Because honestly, you can't change the inflation, you can't change the cost of materials, and you can't change the cost of labor. So let's focus on what we can change and what we can control, shall we? One of the individual factors that affects your insurance cost and therefore your payments is your claim history, as well as, of course, the property location. In other words, the location is one of the things that the insurance companies look at when they quote you an insurance premium or write your insurance policy. Because if a specific location has a higher history of claims, not just yours individually, but a higher history of claims overall, whether those claims are natural disaster related or crime related, this is something that will affect your premiums. I know it may not be easy to relocate. If you already own a house, obviously you can't up and leave. But if you're in the market to buy a house, definitely consider the areas that are less prone to either natural disasters or less prone to criminal activity. And that is something actually that you can find, and Google is your friend. Or you can talk to a friendly insurance agent who will actually tell you in which areas where you're looking to buy, the insurance costs are more affected versus others. So you can also focus on finding a home in the area that is not as expensive to insure. One thing that people forget to do, and frankly, present company included, guilty as charged, did that for many, many years. People forget to review and compare their insurance policies regularly. And this is actually a conversation I had with my insurance agent not that long ago. Circling back to the rising costs, people usually don't look at their insurance policy, especially their homeowner's insurance policy, until they get the renewal bill once a year. In the meantime, we get a shocker, right? The policy almost doubled, or the policy went up by 50%, or whatever the increase is. None of them are rolling back down. All of them are going up. We don't even consider to look at the policies from year to year when there are small incremental increases. We just kind of roll with them. I mean, I stayed with the same insurance company for over 15 years, until a few years back, because it was just a matter of convenience. Of course, the insurance agent was also, or has become, a personal friend, and we did a lot of business together, and I didn't feel it right to actually jump ship and go somewhere else. But once she retired, I was no longer tied to that insurance company, so I went out and started comparing, shopping, and found a much better policy and saved myself about $1,700 a year. Yes, it is that significant. Or, for example, the insurance cost went up by 50% on my home just earlier this year. at renewal. That was a sizable chunk. I mean, that was a very sizable chunk, to be honest. So I just had to reach out to my insurance independent agent and have them take a look at what other options I have. And we were able to bring the cost down, actually. The new policy that I ended up with was, as a matter of fact, cheaper than the original policy that I had in place. So, case in point, do not forget to review and compare your policy. Talk to your agent. Become your agent's friend. Make the agent your friend. Stay in touch with them, and they will look out for your best interest. One more point to make that is actually quite important too. When you review your policy, go over the coverages with your agent because you actually may be underinsured. And yes, raising your limits will unfortunately increase the cost of the insurance policy, but it will actually save you money in the long run because if you're only insured for the old rebuild costs of your home, and something happens, and now you need to have the house rebuild, your insurance company will only pay this much, but the cost is here, the actual cost is here. How are you gonna come up with the difference? So something to think about, maybe not so much cost saving in the immediate future right now, but it's something that can bite you in the ass later on. So definitely review your policies. Not all insurance companies are created equal. And this is where, yes, you should definitely check around, shop for insurance companies, look at the ratings of the insurance companies. Now, here's a little known secret for you, but as a mortgage lender, we have to actually pull the insurance company's ratings when we are doing your mortgage because insurance is a huge part of that process. We need to make sure that the home is insured because we're not just making sure that you're insured. We want to insure our interest in the house because we're writing a pretty damn sizable check for that house of yours in the form of a loan. So God forbid the house gets destroyed. Again, you'll hear me saying that over and over again. Guess who's left holding the bag if your insurance company up and poof disappears? So yes, we do have to rate the insurance companies. So if your insurance company is not a top rated one, it may not even be acceptable for us, the lender, to close on your home. So definitely look at the reviews, look at the ratings, and compare the premiums. And also compare the coverages, because that is also very, very important. Because on the surface, you may be getting a lower premium, but in reality, you may be getting the lower coverage too. So something to consider, and make sure that all the T's are crossed, I's are dotted, and you're getting the adequate coverage for the money. Now, here comes a little tidbit that most people do not necessarily consider. And this is where you actually may want to watch the podcast that I did with an independent insurance agent earlier this year. When you increase your deductible, you're lowering your annual and therefore monthly premium costs. Just like with your health insurance, just like with your car insurance. The higher the deductible, the lower the cost. Of course, consider how that deductible may hit you in the pocketbook when and if, God forbid, something happens. But in the short run, increasing the deductible does the trick in lowering your monthly and annual insurance costs. So the deductibles actually go typically in increments of $1,000, $2,500, $5,000, and $10,000. And on the lending side, we do cap how much of a deductible you can have because it can create an additional financial burden. So typically, I don't usually see the deductibles of $10K, and I believe the limitation actually is 1% of the replacement cost as the maximum deductible. But in the grand scheme of things, if you go from $1,000 deductible to a $2,500 deductible, you're a lot of times looking at saving a few $100 a year. Again, I'm not an insurance agent. Check with your agent, but definitely have them run multiple scenarios for you and multiple quotes. $1,000, $2,500, $5,000. And while, again, the $10,000 deductible is available, I would say that's a little bitey. So no, do not recommend. Definitely do not recommend. This one, most people actually do know about or have heard about it. I would probably attribute it to the abundance of TV commercials. But when you bundle the policies, yes, you do get a sizable discount. Meaning if you bundle or combine your homeowner's insurance with your other policies like auto, you do get a chunk of a discount for both home and auto. So something to consider, instead of having your homeowner's insurance with company A and your car insurance with company B, consider getting them from possibly the same company or the same family of companies. Does it always work? Not necessarily. I recently unbundled my home and my cars because my home premium went through the roof and my car premium went through the roof, and I was getting a better deal by actually splitting them up and getting a better deal through two different companies. But again, look at bundling, talk to your insurance agent, and see what they will tell you. Maybe, just maybe, in your case, it will work out for the better. Have you tried bundling your policies? I would love to see your comments if it helped you save. Like I said, in my case, actually it worked the opposite. But up until this year, it always did the trick. Just like having certain safety features in your car helps lower your car insurance costs, having safety features in your home accomplishes the same goal, like a security upgrade, like an alarm system, fire alarm, or, if you're in a hurricane-prone part of the country, storm-proofing measures that could, potentially qualify your home for discounts. Some insurance companies actually will offer you incentives if your home has enhanced safety measures to it. So once again, check with your insurance and see what they will do if you do X, Y, and Z. Now, here is another little piece that comes in handy sometimes. Besides safety features, oftentimes there are insurance incentives, as in lower cost, if you are affiliated with a certain higher learning institution, as in a graduate of a certain school system, or if you work for a certain company. So again, something to ask your insurance agent is, if I work for company X, does that offer a discount for me when it comes to insurance? Or if I went to school X. Another example is when it comes to car insurance, good student discounts for your kids, because if you have kids of driving age, that's a hit to the pocketbook like there is no other, to be honest. So if your kids are getting good grades, definitely tell your insurance company about it, because that will save you a metric crap ton. While we all can't really stop the insurance costs from rising and from affecting you financially, there are small steps that we all can take, and I encourage you to take them, to at least control some of the cost and lower some of that cost, at least to some extent. So don't like or subscribe if this video wasn't helpful. But now that you've got these tips, was it worth it? Comment below, and I'll see you in the next one.